Good morning, everyone. Thank you so much for coming to the economics section. Today, I'll give you some outlook for what is looking for this year's crop in terms of 2023. I'm Yangxuan Liu. I'm assistant professor and also extension economist with the University of Georgia. The clicker doesn't work, so I have to come back to my computer. So if we want to talk about what is going on or what's going to happen or projected to be happen for this year, we have to review a little bit about what happened in the past 3 years. So a lot of things happened in the past 3 years in terms of the market. We saw a lot of market volatility in terms of cotton prices. So what I showed over here is the past 3 years cotton prices as represented by the area, blue area on the bottom, and then I laid the stock market index, which is S&P 500 index on the top line, which is the light blue line on the top. So this trying to show you what is happening between cotton market and stock market. Historically, and what we observe is the stock market and cotton market follow each other very well. So when stock market go up, cotton market go up. Because cotton is a discretionary item, when consumers get richer and wealthier, they tend to spend more money. That is also the time when the stock market is high. But when the stock market is low, consumer has less money, they tend to spend less. But in the past 3 years, there are some interesting observations that have been seen between stock market and the cotton market. I'll show you shortly. So, during the past 3 years, in the beginning of 2020, what we saw is there a sharp drop in terms of cotton prices, as well as the stock market. That is during the time of the first discovery of COVID, and we all shelter in place, and there's a lot of lockdown happened in the shopping mall, and a lot of lockdown happened during that time for the textile and apparel market. So what's going on during those times is consumers could not go to the shopping mall to buy clothes. Textile and the apparel company temporarily shut down, that they cannot sell, there's no demand for cotton. So during those times, there's a free fall period for cotton prices, that the cotton price dropped from 70 cents per pound to a lower, a little bit over 40 cents per pound. And then after that, the market or the central government quickly stepped in, that put a lot of money into the economy, and with a lot of stimulus bill passed during those times. That's not only happening in the US, but happened globally. So our stock market started to recover pretty quickly. So does our cotton market. So during those times, cotton market recovered very rarely. Within a year and a half, cotton prices rise from over 44 cents per pound or 45 cents per pound at the lowest point to over 90 cents per pound within 1 year and a half. That is over 100% return if you invest money during the bottom and then wait a year and a half later. That is the best investment opportunity I've ever seen since I'm born, or since I'm paying attention to the stock market. So that is also viewed by a lot of speculative investors, that cotton market is a great market to invest in. You can get over 100% return in your investment. So what's happened next? A lot of money going into the cotton market. We saw a lot of speculative money go into the cotton market, push the cotton market higher, lower every single day, and we saw a lot of volatility during this time. So that gives us to the next point, or the celebration point, that we saw the cotton prices shoot sky high, $1.50 at the highest point. And a lot of producers, probably you are really happy, like this is very good price of cotton. What happened during that time is because first of all, stock market is trying to do this up and down jumps every single day. When they go up 1%, the second day drop 1%, another day go up 2%, the second day drop 2%. A lot of volatility in the stock market. So a lot of money pour out of the stock market, trying to find the next best opportunity to invest money. Those is also the time that cotton market are being viewed as a very profitable market. So a lot of money pour out the stock market, flood into the cotton market. That push our cotton prices high. The second reason is during this celebration period of time that cotton that overseas there's a supply chain issue that preventing cotton from moving from the US to overseas. During this time, there's some news that is showing that our agricultural commodity cannot be shipped overseas because of the empty cargo on the port. That a lot of the ship come from Asia with full load of cargo, and then when they're going back to Asia, it's empty because the international shipping rate was too high. It was very high. It makes sense for them to be profitable, to quickly unload everything and then quickly go back, then load agricultural product and then ship the agricultural product. So there's a shortage of cotton fiber for the textile and apparel company overseas, and they went desperate because that time there's a large amount of demand by consumers to consume apparel and textile product. So they have a lot of orders. They have to keep the factory running. So the textile and apparel company, what do? They bid every single bale of cotton available on the market, regardless of the high prices. So that's the reason why we saw the prices shoot to $1.50. So, and also another thing I mentioned is because during this celebration time, a lot of weird things happen. I remember I just talked that usually cotton market and stock market follow each other very well. But during this time, what I observed, this is a screenshot I took on my phone. Every time stock market drop, cotton market shoot high. So this top is the stock market index. You see there's a big drop over here, and then cotton prices shoot really high. That is just one day of example. So we saw multiple occasions during the celebration period. Like here is one example, stock market drop as represented by the orange line, then cotton market shoot high. Another one, and during this time, stock market really dropped, but cotton market is doing its celebration. So after the celebration point, there's a period of realization. Finally, the Fed start to step in to rising, in terms of raising interest rate. The Fed had been rising interest rate very quickly in the past year, and then that gave a signal to the stock market is, hey, economy is not doing that well. You need to cool down a little bit. So a lot of money pour out of the stock market, at the same time pour out of the cotton market. But after that, there's a short period of uncertainty, and there's a short period of cotton market recovered a little bit, as well as stock market. That's because during those times, the profitability for a lot of large corporation reported is higher than expectations because of the high inflation. They earn a lot more money. And also for the cotton market, at that time, there's a drought situation happening in Texas. And USDA reported the number of drought over 60% of crop failure expected in Texas. So all of a sudden, cotton market feel we're going to have shortage of cotton. So cotton prices recover during August of 2022. And what we are experiencing right now is the market what I call market stabilization period. This time is the stock market start to cool down, and maybe we are doing have a more of the downside risk in the downturn, and the cotton market more follows the stock market more closely. And basically, what we are experiencing right now is what is normal cotton market should be. Follow the stock market, as well follow the global cotton supply and demand. So let's take a look at the global cotton supply and demand. So here is the global cotton production as represented by the blue bar, and the global cotton demand. So what we saw for the current marketing year, 2022-2023, there is a drop in terms of global cotton demand. And it has been dropping since 2020. So that means we have more supply and less demand. If there's more supply and less demand, that means there's a downward pressure for cotton prices. And then this chart shows you in terms of where the competition coming from for U.S. cotton. So U.S. is still the largest cotton exporter in the world. Around 30% of the cotton traded globally from the U.S. And then followed by Brazil. Brazil has been really increasing its cotton export in the past several years before 2020. And after that, they start to stabilize a little bit. We don't see more rapid growth anymore, but they still grow tremendously. And then the next one is India, followed by Australia and the rest of the world. Australia is a major competitor in terms of the cotton market with U.S. cotton because they produce high quality cotton as well, similar as the U.S. This chart shows you another aspect in terms of global supply, which is the ending stock globally. So the blue bar here shows the projected ending stock. We saw the ending stock start to rise in 2022, then 2021, and it's maintained a similar level as previous years from 2016 to 2018, but a little bit higher. So when we see there's more supply, there's a downward pressure on prices. The red line on this chart is the global cotton look AA index, which represents the cotton prices traded globally. So usually those price is around 15 to 20 cents higher than what our domestic price is. So USDA projected for this current marketing year, global cotton prices is around $1. So here shows in terms of the U.S. cotton planted acre, harvest acre, and yield per acre. Last year in 2022, we actually planted one of the highest years in terms of total cotton acres in the U.S. 13.6 million acres were planted last year. But remember, because of the drought situation in the Texas and the surrounding states, the harvest acre last year wasn't doing very well. So we had the lowest harvest acre, 7.2 million acres of harvest in terms of last year. But for those acres who got harvested, the yield was pretty good. So our yield level is 939 pounds per acre. That means, except for the places where drought has been experienced, all the other cotton producing regions were doing really good. So, for example, in Georgia, we were doing very good last year in terms of our productivity. And this chart shows you U.S. cotton supply and demand, and also ending stocks. So the dark blue line shows you the production, orange line is the domestic use and also export combined, and the bottom is the ending stocks. So what we say is production is slightly over consumption or demand, and our ending stocks start to increase. So that gave some downward pressure in terms of the cotton prices in the U.S. domestically. So here is the chart for Georgia. I want to show you Georgia cotton production has been on the rise in the past, since 1980s. Last year we had one of the record year in terms of production, 2.6 million bales, and that is a lot higher than 2021. So what factors do we need to looking for coming into this coming year, in addition to the supply and demand situation, both in the U.S. as well as overseas? So I summarized the following 4 bullet points: inflation rate, interest rate, exchange rate, and GDP growth. So let's take a look at those one by one. This chart shows you the inflation rate, global inflation rate that I took for some key countries globally. So U.S. Is over here at 6.5 as current rate in terms of inflation. That has been coming down tremendously since the end of the year last year. And the highest inflation rate in the U.S. was 9.1%. So that means the policy implemented by Fed in terms of rising interest rate has been helpful to slow down the inflation rate. But for the other countries, globally all experiencing high inflation. So it's not only a domestic phenomenon, this is an international phenomenon for inflation that because of the supply chain issues and also the global geographic uncertainty in terms of the war between Russia and Ukraine, inflation is experiencing by a lot of countries globally. So why inflation matters for the cotton market? If inflation keeps at a high rate, eventually consumers have to decide whether they buy food or they buy clothes. Food are necessity. You have to have food to survive. But new clothes, maybe not. So if consumers went to the point that they have to purchase food or clothes, and most likely they will reduce the apparel and textile purchase, and that will give some downward pressure for the demand for cotton, as well as downward pressure for cotton prices. And then interest rate. Since March of 2022, the Fed has been increasing in interest rate at the fastest speed that we've ever seen since 1980s. A lot of you were experiencing the 1980s from financial struggle, and you probably remember the interest rate went 20% to a sky high, and that pushes a lot of producers into financial struggle. This is similar but a little bit different from the 1980s. The Fed is increasing the interest rate at a fast speed as the 1980s, but a little bit lower speed than before. And the Fed has some leverage and also control in terms of helping the economy. So before March of 2020, our interest rate was maintained at a historical low level, only 0.25% as set by the federal fund target range. And since last year, of all this 1, 2, 3, 4, 5, 6, 7 times of increasing interest rate, the current interest rate are sitting at 4.5%, from 0.25 to 4.5. What this translates to producers? That means your loans, mortgage for land, operating loans, purchase equipment, the loan rate is gonna rise for this year. And they will relatively maintain at a high level for the next 3 years, depending on how fast the inflation rate can drop. So I expect if the inflation rate keeps dropping, then Fed will slowly declining in interest rate. But in the next 2 rounds of the Fed meeting happening this year, probably we're gonna see another 2 times of rising interest rate. But at a lower speed, maybe 0.25% each time in terms of rising interest rate for this year. And another part that interest rate plays in terms of the cotton market is the interest rate tied closely with how profitable people invest in US dollar. So when interest rates are high, investing in US dollar is profitable. So that drives a lot of demand for US dollar, and then that drives our dollar to become more valuable. So that is the next one, is that our dollar has been appreciated tremendously over the past year since Fed to start rising interest rate. Why it matters to agriculture? Because US agriculture, we depends on the foreign market. A lot of agricultural products are shipped to overseas market. For cotton especially, over 80% of the cotton produced domestically we ship to overseas countries, ship to Asia, ship to Middle East, to get processed. when the US dollar appreciates, that means our agricultural product become more expensive than the foreign market, more expensive for the foreign consumers, and that will impact the demand for our agricultural product. So that will lower the demand for cotton and potentially lower cotton prices. But the good news is we see a decline of the speed, or we see a decline of the appreciation for US dollar because a lot of foreign governments also trying to raise their interest rate to control the inflation. Remember, inflation is a global thing. They also need to control their inflation, so they raise their interest rate too. So relatively, the US dollar to the other foreign currencies is not that expensive anymore. So we see a decline of US dollar index. The last one is related to the global economy as well as the US economy, whether we will enter into a recession or not. A lot of economists agree if we see two consecutive quarters of economic downturn, that will define the recession. So maybe we had experienced a certain recession pressure during the first quarter and second quarter of 2022, but the third quarter of 2022, the US GDP growth is in the positive level. So maybe our recession wasn't as bad as a lot of the economists was predicting at the beginning of 2022. But this year, definitely, there's a lot more pressure because, first of all, we have the inflation under control. So a lot of business, when they sell their product, the price starts to drop a little bit. The second thing is we have high input costs, not only helping to producers, but also helping into a lot of companies, lot of manufacturers, their input costs rise. As well as in the past 2 years, labor shortage really created pressure for the farming operation. You guys probably already experienced hard to find labor. That's happened the same for the company as well. They have hard time finding labor, so they have been rising the wage rate for a lot of labor. So what we're gonna experience in this coming year, at least for the first 3 quarters, is we have relatively slower or lower level of prices that the company are receiving, but rising of input costs in terms of inputs and as well as labor. So profit margin is gonna be tight for a lot of market. So that really put into a test for the economy of how well we will be doing for this coming year, for the coming 3 quarters. So this is cotton prices that I took a screenshot from yesterday. On the top part shows you the current crop, from the current future prices from March until July, and then the bottom is a new crop cotton prices. So what we see is the current year cotton prices is higher than the new crop cotton prices. That means the market are expecting the cotton prices for this New Year's crop, 2023 crop, gonna be expected to be lower. From my own viewpoint, I think what is the prices right now is at a very high level. It's at a high level relatively to the harvest price level. I did some poll the data from USDA RMA, compare the projected cotton price with the harvest cotton price for crop insurance purpose, and find out in the past 12 years, for all out of the past 12 years, harvest price were able to be over higher than projected price. But for the rest of 8 years, harvest price is always lower than projected price. So this is also very high, and whether we can maintain this high cotton price level, it really depends on what's gonna happen for the next month in terms of the corporate, public traded corporation, in terms of when they're reporting their profitability, whether it's doing well or not. That will send a signal for the stock market. So what we're gonna experience for 2023, there will be a tight profit margin. So this chart shows you the enterprise budget in terms of all the input costs, variable costs on the bottom, and then fixed costs. What we saw over the past few years is input cost has been rising in a very fast speed compared to 2021. So for 2023, compared to last year, input costs didn't rise that fast, but if we compare 2 years ago, it's rising at a very fast speed. So for irrigated land, input costs rise 19% compared to 2021 in 2023, and for dry land, it rise 23% than 2021. So those are the enterprise budget Amanda published online, and you can find the enterprise budget number through UGA. If you Google search UGA cotton enterprise budget, you'll find these numbers online, and you can work with your own number to say how your input costs play a role and how your break-even prices is in terms of trying to put an idea about when is the right time in terms of the market price that signal you to sell cotton prices, signal you to sell your cotton. So another part that really need to pay attention to is the profit management in 2023. These 3 points are what I summarized. It won't be matter a lot for a lot of producers. One is trying to maintain a very well financial situation in terms of your cash flow. What we saw in terms of high profit, high cotton prices for last year is a rare event. Will it happen in the future? Probably, but will it happen next year? Probably not. So you need to really pay attention to during the time of cotton prices start to stabilize around 80 cents per pound. We have our enterprise budget entering 78 cents per pound for cotton prices for the new crop. So that means profit margin will be low and cash flow will be tight. Another one is this is really a year if you want to purchase large equipment, you need to think twice because profit margin is going to maintain tight for next year, and maybe will maintain tight for the coming few years. So you really want to have enough cash flow in case of emergency happen on the farm. And the next one is because of the interest rate is very high at this point, loan management become very critical. When we were going into the county production meeting or talking with our agent, one agent told us that the interest rate or operating loan interest rate last year was 3% and this year was 8%. So that's doubling the cost in terms of the interest producers need to pay for their operating loans. So managing your cash flow well and talk to your lenders to manage the interest cost. So that's all I want to talk with you today. Do you have any questions? I know there's a lot of information. Yes.
You showed, that huge jump in yield, which was driven by the abandonment of all those low-yielding acres. But do we know what for the acres included in that yield, the Georgia acres, did Georgia's yield go up, or was it pretty much historically the same?
Georgia yield pretty much historical the same, but at a relatively high level. We were really lucky last year that we dodged the bullet of Hurricane Irvin. I forgot the name, the hurricane that it went into the sea and didn't go through Georgia. I was really nervous at that time. Man, we had such a good year in terms of the projected yield, but if the hurricane go through, that will wipe us out just like Michael. But luckily it didn't go through. So Georgia the yield is doing very well at high level.
Kind of a follow-up on that question. Now, when USDA comes out with their new crop projections, are they going to go back and use more historical yields, or are they going to use a higher yield and then overproduce or overpredict and, get it all out of whack?
There's always, every year, the discussion about how accurate USDA projection is. So what they do is, around August of every year, they start to project about that year's yield. What they do is they talk with a lot of local expertise, trying to get the yield level estimate. But that is, in season estimation, it always have subject to errors. So they are trying doing their best to make it accurate, but doing projection, there's always a risk.
You were quoted in a competition article that late in 23, crop price would improve.
Right.
Now, you didn't mention that today.
Yes. So later in what we saw right now is, what I expect as the year is relatively high prices. During the planting season, we might see some drop in cotton prices, and at the end of the harvesting season, we might reach the bottom in terms of cotton prices. But after that, I expect the economy start to recover because the supply chain issue ease a lot, and also a lot of the COVID restriction are lifted globally. So I expect the global market as well as cotton market starting in Q4 of this year start to rise again. But we might be experiencing a period of time, a very tough period of dropping prices between now until harvest time. That was what I mean in the article. But thank you for mentioning it. I'm glad it brought people's attention. People reading it.
This is not a year to put put cut prices early. We better wait.
Yeah. The different people have different opinions. My thought is if it covers your break-even cost for variable cost and fixed cost, you need to book it. Or cover the variable cost, you need to book it. So my expectation for the coming year is right now the price is good. So probably book some portion of your cotton right now.
Those prices might be good right now. Not compared to cost.
Yeah, I know it's not good right now compared to cost. But if it beats your cost in any way, book a portion of it to prevent further drop.
How close are y'all, how close are you watching the debt ceiling deal between now and June?
The debt ceiling deal.
United States debt ceiling.
Debt ceiling.
This stuff is, it's gonna be a major player.
Yes, the major player in terms of volatility for the U.S. economy, volatility for stock market. But government always find a way to address the issues. We experiencing debt ceilings, paid debt ceilings before, during the time I was in grad school. The government got shut down for a day or two during that time. I don't remember which year. Probably 2014, 2013.
You settled it before we plant though.
Figure that things out. Yeah, but eventually it'll get solved. But how they got solved, I'm not sure. Yeah, that depends on the politicians.
All right, good morning, everybody, and I'm glad you mentioned cost because that's what I'm going to talk about. A little outlook for inputs and hopefully spend more time on the crop comparison tool where we look at the actual cost information and the potential return of a variable cost. You probably saw me hiding a few slides in there because Dr. Liu did a really great job covering some of the things that I talk about. I am going to mention a few things from the macroeconomic standpoint that will impact cotton demand, production costs, and so on. The good news is that 2022 saw pretty good net farm income despite record high fertilizer prices and very high other production expenses. But unfortunately, the global economy is expected to slow down, as Dr. Liu mentioned, and that's going to impact demand and certainly affect our commodity prices. Now, looking back 3, 4, 5 years ago, they're up, they're higher than they were, and that could probably be related to inflation and some other factors, but they are weaker than they were last year, and commodity prices have come down more than input costs have come down, so again, that common theme, tighter margins for 23. Talking briefly about inflation and the higher interest rates, Dr. Liu really touched on that as well, because I think interest is really the thing that producers are going to be looking at a lot this year. I was talking to a grower a couple weeks ago, and he said, you know, I was just looking at my interest rates and the potential interest rate, and he's like, last year around 4%, and this year I'm looking at 8%. And he's like, you know, if last year my total interest bill was $50,000, this year it's going to be $100,000. So I'm actually going to let go of some rented land because I don't want to pay that much in interest next year. And I was like, okay, interesting strategy. And I'm going to take that nugget and share it at my meetings because it's just something, another thing for y'all to think about when you're making your planting decisions. And I know that is a difficult decision and not possible for everybody. Energy consumption, we'll talk about that as well. It is above pre-pandemic levels. And where that's going, there's some uncertainty, but I think energy consumption is going to stay strong. We may see a little bit of a decline in the second quarter. There's uncertainty to what's going to happen with China now that the zero tolerance COVID policies have been lifted. But overall, the feeling is that after a short period of adjustment, that there's going to be an increase in demand and travel and movement, and so we'll probably see energy consumption increase. Ag production is still bountiful, but unfortunately on the demand side, the disappearance side, exports have slowed. And that's obviously what's really affecting a lot of the cotton prices or the future outlook for cotton prices because of that demand and the slowdown in the economy and so on. Usually at this one I talk a little bit about, okay, so we talk a little bit about what's going on. The Fed is using interest rates to reduce inflation, and they're also looking at unemployment numbers, and economists look at a whole bunch of other things to say, okay, are we going to have a recession? But looking at unemployment numbers, we still have a really low unemployment rate. However, you're probably hearing in the news about layoffs for different tech companies, some in finance. And I was like, well, how's that going to affect cotton? So I looked at the list of companies that have announced layoffs, and Stitch Fix has announced layoffs. And Stitch Fix does fashion for people who don't know how to shop, like me. So you can just subscribe, and they create clothing designs for you, and you just purchase that as a subscription service. So they've announced layoffs, so that's definitely going to affect clothing. And then Bed Bath & Beyond announced layoffs as well. And so that's towels and bedding and curtains and other linens that consume cotton products. So hopefully we won't hear many more of those happening, but that definitely has an impact on demand. All right. Next year, this year, this September, the current version of the Farm Bill is set to expire. And so, the Ag Committee and the chairman of the Ag Committee really want to have a bipartisan Farm Bill passed this year. But they had a really difficult time agreeing on the Speaker of the House. So will they be able to come up with some legislation to pass and create a new Farm Bill, or will the current version be extended into the next year or so? So we'll definitely be keeping an eye on that, and you probably already are, and I know there's a speaker today that's going to talk about Farm Bill 2. All right, so this is just a review of what happened last year, and this is U.S. farm production expenses comparing 2022 to 2021. And the things that really stand out to me are these ones that are over 40%. Fertilizer, interest, fuels, and then close to that is pesticides at 35.6%. So you all know that, you felt that in your pocketbook. The only one that we didn't see an increase in price was seed, but it was basically a no change. Next year, I don't think we're going to see this dramatic of increases of inputs, fortunately. And we may see some categories go down, like in the case of fertilizer and fuels, pesticides, but the decrease is probably not going to be 40%. So we're not going to likely get back to the point where we were in 2021. All right, so land, obviously a very important input, and I know these numbers are difficult to see. However, I'll tell you what they are. So for Georgia, the average farm real estate value in 2022 was just under $4,000 an acre at $3,960. And compared to 2021, that was a 7.9% increase in farmland value. And we were contacted by, I can't remember if it was someone at FSA or NRCS, and they're like, this is what the USDA National Ag Statistics Service is reporting. Is that realistic? And I was like, well, probably. And that is an average value for the state, so there's probably some parts of Georgia, like southwest Georgia, southern Georgia, where we have more row crop production and produce production, where that may be a little bit low. So we may see farm values higher than $4,000 an acre. And other parts of the state where there's not as much of the high value ag production in terms of row crops and produce, that may be a little bit high. All right, so in theory, when interest rates go up, we tend to see farm values or land values go down because people hold off on purchasing land, and then we see rents go up. So 2023, I don't think we'll actually see farm real estate value in the state of Georgia decrease, but I don't think we're going to see it increasing at 8% next year. I do believe that cash rents are going to go up in 2023, and that, again, is something that producers are going to have to think about. Can I afford to rent this land and then pay the interest on the operating note for that? So this data is from the USDA National Ag Statistics Service, from the survey that they conduct every year on what producers are paying in cash rents. And for irrigated cropland, we saw a state average of $221 per acre in 2022, and non-irrigated $73.50 per acre last year. And you can see the increases of those. Now you're probably saying, that's low. It's not quite what it is in my county. So again, keep in mind, Georgia's a very big state, and this is an average for the entire state. If you are curious what the value is for your county, that data is available, and just reach out to me or your county extension agent, and they know how to reach out to me, and we can look that up for you if you're curious. Oh yeah, and this is a quick plug. aglease101.org is a really good website put together by Extension Economist. So easy to understand, publications that explain the different types of lease agreements, and there's fill-in-the-blank lease arrangements there. So now may be a good opportunity to enter into a flexible cash rent. So when times are good, both the landowner and the renter can benefit. And when times are hard, they both kind of pay that extra burden when margins are tight. I thought about hiding this slide, but I decided to keep it in here because credit, obviously, a very important input for producers. And this is a survey conducted by Farmer Mac Ag Lender Survey by the American Banking Association. And it's conducted in August of every year. And it looks at what lenders' top concerns are for 2022. And it's interesting to see how it changes every year. But last year, the thing I find interesting is a lot of these are very internal focused. So they're not worried, last year they were not worried about producers being able to pay their operating notes and so on. So they're worried about lender competition, interest rate volatility, because they don't want to quote you an interest rate that's not going to cover their costs. Weak ag loan demand, shrinking market because of farm consolidation. So all of these are like internal looking and more concerned about the bank and their situation as opposed to their customers being able to pay. So very interesting. I think that's probably going to change next year. because they're probably going to be concerned about high input costs, the ability to pay interest rents and operating notes, and so on. Okay, this doesn't work. All right, so outlook for oil. This is from the short-term energy outlook at the U.S. Energy Information Administration, and it's dating back to 2017, and we're looking at the Brent crude oil spot price over that time period. And the yellow bars are implying a build of stock of Brent crude oil, and the red is when we see a draw on stock. Generally, when we're in the red, we see prices increase, and in the yellow, we see prices come down in general. So the outlook is for us to be really kind of in a supply and demand balance, which is really the goal that they really try to strive for most of the time. But sometimes places like OPEC say, well, we're actually going to cut supply because prices are too low, like they did last year. And then the U.S. is like, no, that's not cool. Don't do that. We don't need higher prices because we've got the Russia-Ukraine war going on. We need to keep prices low because we don't want Vladimir Putin to be profiting. So, and that was kind of before the sanctions were put in place on the oil over there. But the forecast is for prices to be lower. And I checked, I saw a headline today that oil prices were down, and that's based on U.S. production was a little higher than they expected. And they don't anticipate as big of a change in demand in China. So we will definitely be watching that. There's always uncertainty and volatility in the oil and fuel market. All right, so this is diesel retail fuel prices dating back to 2005 through 2023. I should cross that out. January is not correct there. But through 2023, and the projection is for prices to be down compared to last year. I'm using $4.25 a gallon for farm diesel in the enterprise budgets, and I am thinking that that may be a little high if this trend continues, and hopefully that will be the case because that will improve the margin situation in the cost of production. Now, did we pay record high prices last year? From a nominal standpoint, so when we get the invoice from the fuel supplier or when we go to the pump, it definitely looked like it. However, when adjusted for inflation, it turns out 2008 was actually when we had record high fuel prices in terms of diesel. And there's a lot of talk about a push for airlines to use more biodiesel and expansion of the biodiesel industry. So certainly in the future, we can see some relief in terms of that and hopefully less reliance on the petroleum fuels. I know this is impossible to read. It's difficult to read from up here because it's such small font, but I loved how it summarized the behavior of fertilizers, all the different types of fertilizers over time. So this top left, we have urea, top middle, ammonia, ammonium nitrate, bottom left is DAP, bottom middle potash, and the bottom right sulfur. The solid black line are the prices in 2022. And you can see we hit record high prices and peaks for nitrogen fertilizers. But the key takeaway from this is that by December 2022, all of them were lower than the highs that we saw earlier in the year. So that's going to be helpful to that cost of production for 2023. So what's going on currently? Again, another busy slide, but hopefully you can see the lines, and that's really the big takeaway. So this first chart here is a little bit different than the other three. This is the cost of nitrogen per pound, and we're dating back from 2010 through today. The blue and orange lines are the UANs, and the red is the urea. And you can see definitely for nitrogen fertilizers, we hit a record high in terms of prices last year. Compared to a year ago, we are down, or about the same compared to a year ago for the UANs, and for urea, about 18% compared to a year ago. So just looking at these two black lines and comparing those. The next three charts are looking at seasonal behavior. So we go January to December along the bottom, and along the edge, we're looking at dollars per ton. The green line is 2022. The red little speck there is so far in 2023. We've got urea on the top right, and so far we're about $150 per ton less than a year ago for urea, but still 45% above the 5-year average. On the bottom we've got DAP, and we're about the same as we were a year ago in terms of prices, but 55% above the 5-year average, which is this gray dotted line. And then potash, we're about $50 less than we were a year ago per ton, but still 67% above the 5-year average. So historically high, a little bit lower than a year ago, and hopefully the trend will continue down. So the feeling is that prices have softened and should stay lower throughout 2023. Now, the prices that I have here in the enterprise budgets are listed to the left, and they're higher than what you could pay now for fertilizer prices in anticipation for a rise in prices prior to planting this spring. Maybe I'm too conservative there, and hopefully they won't rise up to that point, but you never know. The budgets are forward-looking estimates. They're not actual cost of production based on historical data. So they're estimates into the future that is very uncertain. Oh yeah, the previous slide I mentioned, what is driving the price of nitrogen, because that one, P and K, we actually saw demand for those go down because producers are more sensitive to price increases in P and K. But demand for nitrogen is more inelastic because it's highly correlated to yield. And so producers are still going to use nitrogen even when prices go up because they're trying to get that yield, because it still makes sense to shoot for that. So will demand stay high? That's going to depend on corn prices and natural gas prices. And like petroleums, the U.S. is doing their part in terms of natural gas. This just shows imports and exports, and you can see a steep increase in the exports of natural gas that the U.S. has been doing in the past couple years, trying to keep those prices low. All right, so here's an index of production expenses, and this is U.S. production expenses in the various categories I have listed there on the right. And I usually don't show this, but I wanted to get an idea what a supercomputer could kind of forecast for the future. So the Food and Ag Policy Research Institute has baseline updates. And unfortunately, this is from September, so it's not as current as I would like. But we're going to make do, and I think we'll still get the message that I want to tell from it. So FAPRI has a computer model that does hundreds of iterations of potential outcomes based on historical data and current things going on in the global economy and so on, of what may happen in the next few years. And they actually expand it out to 10 years, but the closer you are to the current period, the closer you are to being more accurate. So I just wanted to look a few years out. So 2021 I set as 100. You can see what happened in 2022. Same old story. We've already heard it. You guys felt it. Fertilizers went high. Fuels went high. Feed prices were pretty good, depending on which side you were on. If you were growing the feed or buying it to feed livestock and poultry. But the outlook is for fertilizers, fuels, and feeds to be down in the next few years. But the other big takeaway is interest expense, and that is looking like it's going to be up and stay elevated for a while. And so, that's where those decisions come into play. Can I afford this extra interest on my operating note, and so on? Can I hold off on a few years to purchase equipment, which translates also into this capital consumption value? That is expected up. So we're looking at working capital being smaller, and we're using more equity and delaying purchases of machinery and equipment. I'm I'm not sure, it sounds like we are getting close to running out of time, so I'll pull up the crop comparison tool really quick for you to look at. This is available if you Google UGA crop budgets. Your county agent can also send you a link to it. And just to show you, this is irrigated cotton looking at 1,200 pound yield. Expected season average price is 78 cents a pound. Our return above your variable costs, which are what it costs to plant, grow, harvest, and market the crop, of $2.42 per acre. Oh, I don't know what that dotted line is in between those, but making your planting decisions, you want to look at what crops are going to give you the return of a variable cost. So you can adjust the yields. So these are just budgeted yields that we have in there, and these are based on the enterprise budget. So again, estimates of cost of production. If we are too high in our fertilizer estimates, like if I was too conservative, we could plug in, or you could actually go ahead and play with the numbers now and plug in a current cost of urea. That's still a little bit high, but change the P and the K and see how that will affect your bottom line. Or say, okay, given that cost scenario just with inputs, and I didn't change the fuel prices, I need a break-even price of 1,200 pounds, on 1,200 pounds of irrigated cotton of 56 cents a pound, just to cover my variable costs, but we don't have land rent in there. And on non-irrigated cotton, we need a break-even price of 72 cents a pound. So if I was to plug in the state average land rent, and the interest rate that I have in there is 7.5%. Okay. So there, for non-irrigated cotton, you're going to need a break-even price of 82 cents a pound, and irrigated, and that's 750 pounds. And irrigated at 1,200 pounds, you need a break-even price of 75 cents a pound. So I encourage you to play with this crop comparison tool, take a look at the enterprise budgets, get as close to accurate as possible representative for your farm on estimate for your cost of production, so you can help figure out what your cost of your break-even price is, and then market some of your crop above that if possible, or at least have an idea of what you need to break even and cover that yield, or break even yield to